Hey everyone, welcome. In today's explainer, our goal is to completely demystify the math of wealth creation. We're going to just strip away all that intimidating financial jargon and look at the pure, undeniable math behind building a fortune. Whether you're just starting out in your career or maybe you feel like you're a bit late to the game, I promise you, by the end of our time together, you're going to see your money in an entirely new way. In fact, to kick things off, I want to show you a totally mind-bending mathematical trick that proves exactly why this works. Okay, let's dive right into this with a quick brain teaser. I want you to picture a standard piece of printer paper. It's insanely thin, right? About 0.1 millimeters. Now imagine folding it in half so it gets twice as thick, then fold it again so it's 4 times as thick, and again, and again. Here's the exponential math puzzle I want you to guess. How many times do you need to fold that single piece of paper for its thickness to reach all the way to the moon? Lock in your answer. Are you ready for the reveal? It takes just 42 folds to reach the moon. And if you actually manage to fold it 50 times, you would literally reach the sun. I mean, I know that sounds absolutely impossible, but this staggering answer beautifully illustrates how exponential growth and compounding work over time. Our human brains just aren't wired to easily comprehend exponential curves. But once you grasp it, you realize that repeatedly multiplying a small base creates an absolute explosion in value. And that exact same law applies to your savings. So here's our roadmap for the explainer today. First up, the magic of compounding. Second, time beats money. Third, the investment toolkit. Fourth, strategies for late starters. And finally, the dark side of compounding. Let's get to it. All right, section 1, the magic of compounding. To prove this isn't just, some textbook theory, let's look at a 200-year experiment set up by Benjamin Franklin. He intuitively understood this concept, famously stating, "Money makes money, and the money that money makes money." It's what modern investors like to call the wet snow and a long hill concept. The wet snow is the interest you earn, which you then reinvest to pick up even more interest as it rolls along. And the long hill? Well, that's the time you give it to roll. So Franklin left a really modest sum, about $8,800 in today's money, to Boston and Philly, with strict rules that it had to be loaned out with interest and just left to compound. Over 200 years, that modest original sum exploded into nearly $6.5 million by the 1990s. He basically proved to the world that compounding isn't just a fun idea, it is an undeniable mathematical reality. It's a snowball picking up massive, unstoppable momentum. Moving on to section 2, time beats money, and why it's your ultimate advantage. Now, obviously, you and I don't have a 200-year timeline, so let's apply this to you right now. Look at this stark contrast. Let's say you invest just $100 a month from age 22 to 32. You're putting in just $12,000 total, and then you never add another dime. At an 11% historical market return, that grows to a whopping $628,000 by age 65. Now compare that to someone who waits until age 45. They kind of panic, right? And they start investing $1,000 a month for 10 years. They're putting in 10 times the money, $120,000 out of pocket. But because they had way less time to compound, they actually end up with less money at age 65, only reaching about $570,000. Now, what's really interesting about this slide is how vividly it proves the point. Check out Michelle versus Matt here. Michelle starts early, puts in $250 a month for just 10 years, and then stops completely. Her out-of-pocket total is $30,000. Matt waits 10 years, then contributes that exact same $250 a month for 30 whole years. He puts in $90,000 out of pocket. Yet, Michelle still massively beats Matt by over $130,000 at retirement. Time did all the heavy lifting for her. And this brilliantly illustrates exactly why that happens. Just look at this growth curve of a single $10,000 investment. Notice how the lighter color at the bottom, which is your initial investment, stays exactly the same. But watch that darker area sweep upward. That is your earnings compounding on top of your earnings. Eventually, the interest you're generating completely dwarfs your original contribution. Your money is out there working far harder than you ever did. Okay, section 3, the investment toolkit. Because, let's be real, you can't just stuff cash under a mattress to get these returns. You need calculated risk. First step in the toolkit, we have equities, commonly known as stocks. When you buy a stock, you aren't just trading some random ticker symbol on a computer screen. You are buying a literal piece of a living, breathing business. If that company grows and becomes more profitable over the next 20 years, your slice of ownership becomes more valuable. This right here is the primary engine for long-term compound growth. Next up, we have bonds. So while equities make you an owner, bonds make you a lender. You're loaning your money out to a corporation or to the government. In exchange, they promise to pay you back your principal plus a set amount of interest. It's essentially a debt instrument. It usually offers lower returns than stocks do, but it provides much more stability to your overall portfolio. And finally, we've got mutual funds and exchange-traded funds, or ETFs. Instead of trying to guess which single stock or bond is going to be a winner, these funds bundle hundreds or even thousands of investments together into one big basket. This is great because it allows everyday people to easily buy a wide swath of the entire global economy all at once, which brilliantly spreads out your risk. So let's look at how this actually builds your strategy step by step. Risk and return are forever linked. At the bottom step, cash and CDs are totally safe from market crashes, but they're incredibly risky when it comes to inflation. They literally lose purchasing power over time. As you move up these steps into bonds and then into stocks, sure, you take on more short-term volatility, but you unlock the higher returns necessary to fuel that exponential compounding curve we saw earlier.
All right, Section 4, Strategies for Late Starters.
If you're in your 40s or 50s and you feel like you've got zero saved, listen. Do not dwell on the past. We've got a plan. Here are your 4 highest impact tactics to catch up starting today. First, claim your employer 401k match immediately. If they offer 3%, you put in 3%. It is literally free money that instantly guarantees a 100% return. Second, kill your consumer debt. We'll see exactly why in just a second. Third, unlock your home equity. Downsizing or relocating to a cheaper area can instantly convert a non-earning asset into hundreds of thousands of dollars of fresh investment capital. And fourth, use IRS catch-up rules. If you're 50 or older, the government legally allows you to stuff extra money into your tax-advantaged retirement accounts. Use that to your full advantage. And finally, Section 5, the dark side of compounding. Because compounding, it's a double-edged sword. When debt is involved, it can literally destroy your wealth. So the absolute crucial point is understanding this number right here, $3,994. Imagine you walk into a store today and buy a nice $2,500 television using a credit card with a 16% interest rate. That $3,900 figure isn't the total cost. Actually, scratch that. It's purely the extra interest you will pay on top of the $2,500 if you fall into the trap of only making the minimum payments. Let's spell out exactly what that actually means in the real world. If you only pay the $50 minimum on that card, compounding interest stretches that single TV purchase out over nearly 22 years of your life. You're essentially financing the bank executive's retirement instead of your own. Minimum payments turn compound interest into a vicious trap, keeping you on a treadmill where the debt grows faster than you can realistically pay it down. Which brings us to the ultimate question you've got to ask yourself after going through this explainer. Is compound interest currently acting as your greatest ally, building exponential wealth for your future? Or is it acting as your most expensive enemy, quietly draining your resources through debt? The math is exactly the same either way. The only difference is which side of the equation you choose to stand on. Take control of your financial timeline today. Thanks so much for joining me, and I'll see you in the next one.